He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
Money matters can seem complex and confusing, but they don't have to be. I'm Jesse Mulligan, and every fortnight on afternoons on RNZ National, personal finance whizz Mary Holm joins me to talk about what to do with your money. It's a straightforward and jargon-free conversation. I'm Jesse Mulligan, and you're listening to an episode of Your Money with Mary Holm. The war in Iran is causing global market uncertainty. Mary joins me now to discuss what that might mean for you. Hi, Mary.
Hi, Jesse.
We got this message from an RNZ producer, actually. One of the team has seen a quite dramatic drop in their US ETFs and knows that your advice will probably be to write it out. They're obviously a long-time listener, Mary. But they wondered if it would be wise going forward to move away from the United States and start investing in more stable markets. I'm fascinated by your response to this one.
Yeah, well, and the short answer is, yeah, it's not a bad idea. But first of all, I thought we should just quickly say what ETFs are, because I imagine some listeners don't know. It stands for Exchange Traded Fund. And they are managed funds just like KiwiSaver funds, other funds where the fund manager owns a whole lot of investments, in this case shares. They're usually passive funds, so we've talked about that before, you and I, index funds. So they invest in all the shares in the share market index, but not always. And sometimes they cover just one country's shares or even just one industry, or sometimes they cover bonds. They're a relatively new type of managed fund. Some KiwiSaver funds invest in ETFs, but for listeners who aren't right up with that game, just think of them as share funds, basically funds that own a whole lot of shares. So the person on the RNZ team was wondering that he or she is in a US one, which holds a whole lot of shares and a whole lot of American shares. And that's turned out to be a pretty nice investment. Like, since the global financial crisis, the US market has grown faster than the world markets, and so it's done pretty well. But, the S&P 500, which is a huge, big American share market index, which holds 500 shares, just 7 of those shares make up more than a third of the index, more than a third of the value of all 500 shares. It's just 7. And you can probably guess what sort of industry they're in. Yeah.
Makes it feel pretty precarious, doesn't it?
It does. So
because
all
usually you get
yeah.
ETFs in order to get diversity. Normally that would be the case.
That's right. Yes, yeah. And but, you're basically putting a heck of a lot of your money in high-tech companies, which have done extraordinarily well. But will that continue? That when you look at American ETFs, they've actually not kept up with world shares since the end of 2024. They've still grown, but not as fast. And when you look back in history, there have been other periods where the American market's done worse than the world market, quite long periods like 1971 to 1989, and then there've been a couple of sort of crashes this year. One was just, this century, one was just the turn of the century with this big tech stock crash that some people might not remember, who are getting very excited about tech shares, or all these high-tech shares that crashed, and the value of the shares plummeted for a while there, just around the turn of the century. And then there's been the global financial crisis as well, in 2007 to 2009, where these companies took a particularly big drop, and that could easily happen from now on. Where, as you say, the world's sort of anything could happen at the moment, and so the person saying, well, what market should I move into? Now, the American market makes up about half the world shares, roughly speaking. The next biggest share markets are China, Japan, Hong Kong, India. So the Asian markets come in second, but still the American market dominates. But I was looking for my book Rich Enough when I was doing research for that, looking at the biggest 9 markets in the world, plus New Zealand and Australia, and how they've done all the way from 1985, when the New Zealand stock market was booming and most of the world ones were. And when you look at the individual years since then, every country, every one of the 11 countries I looked at, has had the best performance at least once and the worst performance at least once out of all those countries.
Right.
So
that's not much help, is it?
No, it's not. And China, by the way, has had the most best and the most worst. It's been pretty volatile. So I wouldn't necessarily suggest that your colleague moves to a Chinese fund. But New Zealand had the highest return of all of them since 1985, and that was 111%, right before the share market crash. But then in 87, but then in the crash it had the third worst performance ever. So New Zealand sort of shines out on the list in perhaps an ignominious sort of a way, really. But yeah. But the main point I wanted to make from looking at that data was, at a quarter of the time, over the 41 years, the country that did best one year was the worst performer the next year, or the reverse. They went from worst to best or best to worst in a single year. So that's an interesting thing that quite often happens. If a share market oversells, people, there's a crash and everyone sells their shares, and then people say, hey, this is ridiculous. Suddenly the companies aren't worth that much less, and they all pile in and buy again, and the market sort of zooms straight back up again. So the markets are, if you look at individual country markets, they're volatile as anything, and so it's not a smart idea to try and pick a winning country to invest in. The thing to do is to go into a global exchange-traded fund or other share fund. And this applies to KiwiSaver too. I think it's a really good idea to have your investment in a global market, because when one economy is doing badly, another one's quite likely to be doing okay, I mean, there are international trends where all the countries tend to do well for a while and all do badly for a while, but there's also certainly tendencies for when one country is doing badly for some others to be doing well, to sort of, and that smooths out the flow. It's good old diversification again, basically.
Yeah. You won't get rid of the volatility totally, but you'll do the best you can to get a good spread.
Yes, that's right. It's and you're in all, if you're going in a big global fund, you're in all the industries in the world. You're not just in high tech. You're in all these other industries, for good and bad, around the world, and all these different economies. And it's easy enough to do within KiwiSaver or outside KiwiSaver. Within KiwiSaver, many of the providers offer a global share fund as one of their higher risk funds.
Yeah, I was going to say, how hard is it to get into one of those global funds?
Yeah, it shouldn't be hard at all. If your provider doesn't, if you look at what aggressive funds or growth funds your provider is offering, a growth fund won't be fully shares. It'll have a bit of bonds or something else in it, but have a look and see if they've got an international fund. And if they haven't, move to one that does. Just do a Google search on international funds and KiwiSaver or something like that. There's many of them do have an international fund, and some of them, in fact, even have are in international ETFs, but that's not necessary to worry about. Just get into an international fund. It's where I've plonked my retirement money since I first started saving back in America when I was in my 20s and was in an equivalent to KiwiSaver. Plonked it into international, passive international funds and just left it there, and it's grown hugely. It just, if you leave it and ignore the downturns. So sorry, go on.
Yeah, well, you still, like I say, you're still going to get some volatility, and there might be people out there going, this doesn't sound like me at all, even the global fund. So what do?
Well, if they're in a fund that's been performing, wobbling around too much lately, they've either got to grin and bear it, or if they really feel they can't, reduce your risk, whether we're talking about KiwiSaver or else we move into a middle risk balanced fund or even a lower risk conservative fund. I think it's best to actually move it a bit gradually. Don't move the whole lot today. Move maybe a third today and a third in a month and a third in 2 months, and that way you don't end up moving the whole lot right at what was a particularly bad time to make the move. But if you're one of those people who's reducing your risk because you have seen the markets wobbling lately, don't go back into higher risk when things seem to have settled down again. Those people that go back and forth, end up with a lot less money because they tend to be moving at the wrong times. And, a lot of research shows people just